We will now discuss the solution to problem 8-21, which requires us to prepare a schedule of expected cash collections and cash budget. Problem 8-21 talks about Natural Care Corporation, a distributor of natural cosmetics, that has requested a $60,000 90-day loan from the bank. The bank is concerned, this company's had some difficulty in the past, and in order to approve them for this loan, they want to see a cash budget for the third quarter, which includes the months of July, August, and September. They give us the actual sales for May and June, and budgeted sales for July, August, and September. Experience shows that 25% of the month's sales are collected in the month of sale, 70% in the month following, and 2% in the second month following the sale. Therefore, first things first, let's prepare a schedule of cash collections. Schedule of cash collections requires us to look on a month-by-month basis and determine how much cash we will receive in that particular month. For the month of July, we're obviously going to collect some portion of July sales, that being 25% of the $350,000, or $87,500. That's the obvious. We're also, since it takes us 3 months to collect all of the cash that we're going to collect from sales, we need to go back to the month of June and back to the month of May. May is 2 months prior, and when sales occurred in May, 25% would be collected in May, 70% in June, final 2% in July. So 2% of 360 is $7,200. For the month of June, all right, which is the month prior, when sales were derived in June, 25% of them were collected in June, and the next 70% were collected in July. 70% of $280,000, $196,000. So all told, when you look at the cash collections for the month of July, you have those from May, June, and July totaling $290,700. When we next go to the month of August, you'll notice that in August, we'll take care of the August sales first. $420,000 of sales in August, 25% of them collected in August, therefore $105,000. We then need to go back and look at July. Well, July sales, 70% of July sales collected in August, or $245,000. All right, there. And going back to the month of June, which is 2 months prior to August, we will collect the final 2% of those sales. Keep in mind, we're only collecting 97% of all sales. The other 3% are uncollected. So 2% of 280 is $5,600. For the month of September, all right, we're going to collect that 25% of September sales, 25% being 360, being $90,000. For August, we're going to collect 70% of the 420, or $294,000. We're then also going to collect the final 2% of July, or $7,000. We add up each of the columns. We can also add across. All told, for the quarter, we'll collect $1,037,300. This is very important, the totals for each of the 3 months, because we will then drop this figure right into our cash budget. If you scroll down to the cash budget as I've done here, let's walk through the solution of the cash budget. Part 1 asks us to prepare the schedule of expected cash collections, which we just did. Part 2 asks us to prepare a cash budget. We're going to start with, in the month of July, our cash balance as told in the problem is $43,000. Add to that our $297,000, all right, of collections that we calculated for cash to be collected in July. And then pretty much the disbursements are as laid out in the problem. Right? There's a schedule for July, August, September. So we do a couple tricks. One is that merchandise purchases. We make the purchase of merchandise in 1 month and then pay for it the next month. So in the month of July, we are actually going to pay for merchandise we purchased in June. So in the book, they tell us that merchandise purchases in June that were paid in July total $160,000. Salaries and wages, advertising, and rent are given to us in the book, as so is the equipment purchases. Letter D there, equipment cost of $25,000 is purchased for cash during July. The only other trick to note is depreciation for each of the months is $40,000. Depreciation is a non-cash charge, therefore not included in the cash budget. So at the end of the day, what we do is we add up our total cash available, which is beginning cash, plus collection from customers, minus total disbursements, to give us an excess or deficiency, in this case a deficiency of receipts over disbursements, where we've spent more than what we've had available by the amount of $31,300. And that is the reason for the loan of $60,000, which we took out in July, or expect to take out in July, giving us an ending cash balance of $28,700. Looking further, the ending balance of 1 month becomes the beginning balance of the next month. So $28,700 is our balance at the end of July, becomes the beginning balance in August. To that, we add our collection from customers of $355,600. To give us cash available of $384,300. We then list out our disbursements, which once again, the only real trick here is that the merchandise purchases is the actual merchandise purchased in July, paid for in August, for the amount of $170,000. So total disbursements $360,000, subtracted from our cash available of $384,300, gives us an excess of receipts over disbursements of $24,300. Giving us an ending cash balance of $24,300. That becomes the beginning balance in September. Added to that is our cash collections of $391,000 that was found previously right here in our schedule of cash collections, giving us cash available of $415,300. Once again, we subtract merchandise purchases, salaries, advertising, rent. Total disbursements $350,000, leaving us an excess of receipts over disbursements of $65,300. We then subtract out first interest when we make debt service payments. The first amount of money is allocated to interest. They tell us $2,000 of interest will be paid in June. If we were to repay $60,000 of total loan balance, we'd have total debt service or financing payments of $62,000. Leaving us with an ending cash balance of $3,300. Now, the book tells us that the bank requires to maintain a minimum balance of $20,000. Therefore, we will not be able to pay back the full $60,000. So, question part 3 asks us whether or not we'll be able to maintain a minimum cash balance of $20,000 if we were to pay back the full loan in September. The answer is no. The last thing I would just make mention of is the quarter totals. You want to be careful if you're to calculate the quarter totals. The quarterly beginning balance is the beginning balance of the quarter. Well, the beginning month of the quarter is July, therefore the beginning cash balance, the balance that was for the quarter, is that which existed on July 1st. You will be able to add across the collection from customers. You will be able to come across and get the cash available. And you'll be able to add across for all of these items, for all the disbursements. You want to be careful. You want to subtract cash available less total disbursements to give you excess of $5,300 of receipts over disbursements. Drop in your financing coming straight across, and you find out that you have a cash balance ending of $3,300, which is in fact the ending cash balance for the month of September. This does it for our discussion of the solution to problem 8-21.
We will now discuss the solution to problem 8-23 on page 375. This problem is very similar to problem 8-21, which we just went over. In this problem, Jody Horton is the president of Crestline Products and has just approached the company's bank with a request for a $30,000 90-day loan. In order to get this loan, the bank wants to look at a cash budget for the second quarter of the year, which include the months of April, May, and June. We are told that the cash balance at the beginning of April was $26,000. We're told that accounts receivable was $151,500, of which $141,000 will be collected during April, $7,200 collected during May. The remainder's uncollectible. We're also told that the past track record is that the company will collect 20% of a month's sales in the month of sale, 75% in the month following sale, and 4% in the second month following sale. The other 1% represents bad debts never collected. We're also given a schedule of disbursements for the 3-month period. We're told a little bit about how merchandise purchases are paid for. They're purchased in 1 month, paid for in the next month. And the first requirement says prepare a schedule of expected cash collections for April, May, June, and the quarter in total. When you look at this, you will notice that the month of April, you will see we will collect $141,000 that was in accounts receivable at the beginning of the month. That will all be collected. And we will also collect 20% from April sales. April sales were $200,000. We will collect 20% of them, or $40,000. When we look at May, we're going to collect $7,200 as given in the book, plus we're going to collect 20% of May sales and 75% of April sales. 20% of May sales being $60,000, 75% of April sales being $150,000. We then go to the month of June. We're just going to collect 4% from April, 75% from May, and 20% of June. Since we are in June, we collect 20% of that month's sales of 20% of 250 equals 50,000. We will collect 75% of May sales of 300,000 to get 225,000, and we'll collect 4% of June sales of 8,000. All told, we will collect $181,000 in the month of April, $217,200 in May, and $283,000 in June. The quarter we will total out to be $681,200. Next step in this process is to calculate the cash budget. And the cash budget for this quarter is as follows. We will start the month of April with $26,000. Add to that our collections from April of $181,000 to give us cash available $207,000. We then take the the disbursements for the month of April, as given in the book, adding in equipment purchases of $8,000 as we were told in the chart, leaving out depreciation. Depreciation is a non-cash charge. We do not include that in a cash budget. And the only other trick is the fact that merchandise purchases total $120,000 in April. However, they won't be paid for until May. We are in the month of April going to pay for the merchandise purchases made in March, which total $108,000. So total disbursements add up to $210,000. Subtracted from our cash available of $207,000 leaves us a deficiency of $3,000. Add our borrowings of $30,000, we end up with an ending cash balance of $27,000. That ending cash balance of April becomes the beginning cash balance of May. We add to that collections from customers of $217,200 to give us total available $244,200. We then subtract out our disbursements. We have merchandise, payroll, lease payments, advertising as given in the book. Only trick being merchandise purchases are from the month of April. Total disbursements $224,000. When we subtract that from our cash available, we have an excess of cash receipts over cash disbursements of $20,200. We make no debt payments during the month of May. We now go to the month of June. We ended May with $20,200. We begin June with $20,200. We take in our collections from customers of $283,000 to give us total cash available of $303,200. Take out our disbursements, $180,000 for merchandise purchases, which is the actual merchandise purchased in May, paid for in June. Payroll, lease payments advertised as given in the book. Total disbursements $263,000. Subtracted from cash available of $303,200 to give us an excess of $40,200. Subtract out the repayment of the loan of $30,000 and the respective interest of $1,200. We're left with a cash balance of $9,000. Now,